right, welcome back to Bridge Academy. This is Ms. Krewalt, and we're going to continue on in free market economics. We're on Unit 2, and we're going to start Lesson 3, Part A. And in this particular section, we're going to be talking about building off of that career capital that you just acquired in college or in your first few years in a job. How are you going to turn that capital into a larger business or a really good career job? And also, once you start improving and increasing your income, you're going to be looking at ways to further increase it by investing, and also looking long term in terms of retirement. That's why you're doing the investing now. We'll go over some of those investment plans. We're going to be talking about benefits as well. Depending on what your situation is, you may either be offered benefits or you may be looking to purchase certain types of coverages because you have your own business and you don't necessarily have an opportunity to join in a group plan. So we're going to be talking about those situations. And then when we get into the second half of this lecture, we're going to be talking about buying a home and paying taxes, because believe me, the government's on to you. You're making money, you're successful, and they want a cut of the pie. So let's get started. I opened with this quote from Ben Shapiro because I just thought it was so appropriate to being at this stage in your life. Ben Shapiro is a young, very successful lawyer, talk radio show host, and an author as well. And he's very popular with the young professionals, especially the conservative young professionals. And so he makes a comment about, just basic security. And it goes like this. When people are desperate or wealthy, they turn to socialism. Only when they have no other alternative do they embrace the free market. After all, lies about guaranteed security are far more seductive than lectures about personal responsibility. What he's trying to tap in here is that it's very hard, especially in today's culture, to fall for the idea that the government is going to somehow create a long-term security for you. That, Social Security and the benefits of Medicare are going to somehow be there for you in a very beneficial way. And I don't think you're going to realize, one, remember the debt clock? Okay, those benefits are not going to survive this debt crisis that we're in. As well as don't ever rely on the government to provide you something as important as health care. Okay, you don't want to be in that position. That's a desperate situation to be in. Because what happens is when you let someone else create your security, you are handing over the responsibility for all the decision making to that other entity. So do you want the government to decide which of those prescriptions that your doctor prescribed? They're going to say, well, you know what? We don't really cover that. But here, you can use this other prescription. Okay, that's what starts to happen. That's where the lines start to bleed. And these things do not pan out the way people expect them to. So as of right now, because Obamacare has completely destroyed the healthcare industry, we're starting to see this other alternative that Shapiro is talking about. People starting to embrace the free market. And we talked about that. We talked about that being an option that especially young doctors are trying to get in there and provide free market healthcare, because they don't have an option. As a doctor, they're not having many options available to them in this nearly socialized medical industry that we have now. But the flip side of this that Shapiro's talking about is that you have to take personal responsibility. You have to seek out these other free market options. You have to go negotiate. You have to find someone that you can rely on to provide these services to you for the price that you're willing to pay them. That's the part that you've got to be willing to take on. Okay, let's start this lesson. We're going to be talking about peak earning potential. And what I mean by that is, now that you've got your foothold in a career or your business is starting to take off, your goal is going to be to increase your income to the maximum possible potential, right? I mean, obviously, there are limited resources, but you have insatiable wants. And you're going to be growing. You're probably looking to get married, start a family. All of these things are going to cost money, and you want to be providing security to that family. So we're going to look at that, and we're also going to look at your peak economic activity. And I'm talking about peak. I mean, over the course of your lifetime, you're going to be running and gunning, and you're having children. You're at the peak of your earning potential at your job. You're at the peak of your career, and you're going to start buying things, okay? Investing in things. And those decisions are very critical to your economic outcome. Remember way back in lesson 1, what's going to be your economic outcome? Well, a lot of that's going to depend on your savvy when you go in and make purchases. And buying a home is, of course, one of the most significant purchases you're going to make in your lifetime. And we're going to learn how do you buy a home. All right, this first slide here, I just wanted to put that concept in your mind that when you went to college and got a degree, or you got your certification in some kind of trade, or you spent a year, you've already spent a year on the job and you've been working, you've had a profitable year in business, or you've had your first year in business, or you've completed a service agreement, maybe with the military service, some kind of mission work that you've been doing, you need to consider that like capital. That's like cash in the bank. You want to preserve that. One, don't squander it, okay? Don't just turn the corner and forget that you did all that. Look back at what you've done, treat it like cash, and reinvest it. Put that capital investment to work. Okay, let me read this next quote from the Callahan's book. When pricing a particular capital good for the purposes of capital accounting, it is a mistake to look back to the price that was paid for the good. Rather, the firm must look forward to the various streams of revenue it expects would result from different possible uses of the good. What he's trying to say here, when you're thinking of the capital you have accrued through your training or your service, and you're going to make an assessment of the value of that capital, what does a person with this degree get as an income? And how are they investing that income to get further dividends from it? You know, they're going to keep on investing it. What has been their career path? Okay, you want to always focus on that, because the price you paid for your training is irrelevant at this point. And also, when you put that price of what you paid for your training together with the uniqueness that you're going to bring to it, that's a totally different valuation, okay? Because you have made it your own work. It may have been training you received from somebody else and they gave you a piece of paper and it says that you did this, but that doesn't have any reflection on the fact that you brought your uniqueness to this degree or to this certification. That is what you need to value. Let me try to give you a good example. I work with seniors, so I'm always seeing their graduation, which is just a joy to me to be able to do that, because typically seniors take government economics. So economics is like the last thing they take before they graduate. And this young woman that graduated in her class that I taught for government economics, she's going to get a high school degree. Well, so are all the other students in that class, and so are all the other seniors in the United States going to get their high school degrees in May and just be thrown either into the workforce or into college or into training, etc. So how is she going to differentiate her high school degree from the next person's high school degree and then put a value on it? A literal income value on that uniqueness that she has. For some people, it's very obvious that, say, they're just exceptional physics students, or, they just have a gift for teaching, and that's very obvious. Well, I had never really talked to this young woman about what her plans were after she was going to leave this senior year. But about halfway through the first semester, I gave the students an assignment in which they had to make a presentation. And as we're going through the presentations, she came up and delivered her presentation. And I was absolutely floored. This young woman never spoke in class. She never really answered questions or put up her hand or offered answers or anything like that. So I never really had heard her speak before, especially in a presentation format. But she had an incredible natural ability to be very comfortable speaking in front of people. Her delivery just had such a unique character to it. She was very genuine and approachable. Like you felt very comfortable asking her questions. She wasn't aggressive or necessarily bold. She was just very comfortable looking up there. And that delivery put everybody in the audience at ease, and you could just feel that. And so I watched her over the year as she was given deliveries, and it was the same thing every time. She just always came through when it came time to make a presentation. And at the end of the year, we had our first Shark Tank competition, and it was, in other words, like an entrepreneurial competition. And she gave her presentation, and I put her up there first because I knew she was going to do a great job. But we had 5 judges, and I put her up there first. And at the end of the competition, when I was able to kind of double back with the judges and talk to them, that was one of the first things they said. They said, that first young woman just had the best delivery of all of the competitors. To have that confirmation come in from judges who had never seen these students before, who had no idea what they were about to present or what kind of person they were or what their strengths were, then to have them without provocation, I didn't ask them any questions about her. They just simply offered up that information, and it was very satisfying to hear that they were confirming what I already knew. And, that kind of uniqueness, that's what you hone in on. That's like your ace card that you pull out when it's time to negotiate something. Okay, you want to put your best foot forward when you're taking this capital that you've accrued, and you want to make sure that the person you're talking to gets an idea of what that is. That's the best thing you can do. It sounds like I'm just saying, hey, you got to be self-confident when you go in and interview. That's not what I'm saying. This young woman had a talent for delivering a good speech, for delivering a good presentation, especially when it was just her talking. So you can apply this concept to any gift. You must identify this thing about you. And once you identify it, then you go out and you find out, well, where can I use this gift? And how am I going to maximize my economic return as a result of that? If you're good at something, go do it. Okay, remember, profit is not a 4-letter bad word. It's called your paycheck. Okay, it's called you receiving a reward for specializing in a particular area of work or industry or talent. Okay, it's you giving back your gift to the world. And you know what? You deserve a reward for that. And the American system is supposed to reward that. That's what the whole idea of issuing patents was in the Constitution. The individual is important, and what they offer is important. Okay, and it deserves to be respected, and it deserves to be protected, and it deserves to be rewarded. That's how the American system works. Okay, on this next slide, I put the little cute chameleon on here because I wanted you to get that idea of when you're in a different environment or in a different condition, sometimes you're going to have to adapt. Those that can adapt perform better and get a higher reward. This quote from Gene Callahan explains this when he says, entrepreneurs realign the structure of the reef in their ceaseless quest for profits. They succeed only in the new alignment that better matches the desires of the consumer than did the previous one. Successful entrepreneurs are constantly watching their consumers. Are they delivering them a good product? Is the consumer happy? Are they getting feedback that's negative or are they getting feedback that's positive? What is working? They're constantly reevaluating this situation. And you don't have to be a big, fancy entrepreneur to do that. You can just have a job and do that. Think about it in your job. It doesn't matter what kind of job you have. Who is the end user of the product or service that your job provides? It's not your employer. Okay, your job is not to make your employer happy. That's called being an indentured servant. That's not a position that you're supposed to take up. Your position to take up is to own your job. Okay, you look at the end user. I don't care if you're serving Cokes on the other side of a cash register. It's about the customer that business serves. So, and I put on here that sometimes that benefit is not the intended benefit to the customer. Maybe you're realizing this customer really isn't being served here. Like they need to go somewhere else to get served. I think one of the smartest business tactics some businesses employ, and I mean use when I say employ, is this idea that, you know what, I think you can get a better deal somewhere else. Okay, that's incredibly effective with a customer. And this can be just as simple as saying, Progressive does this, and they'll say, we're going to give you 3 options. You can go to Allstate and it's going to be cheaper because we don't really serve this market. This isn't our target market, and so we can't really provide a good price for this particular coverage. What that says to a customer is that this business or this person that's serving me is looking out for my best interests. They're willing to forego this sale so that I get the best result, even if it means they don't get the sale. That line of thinking wins you customers. And there's also a flip side to this coin. When your customer just starts to feel like another number, they start to feel like they're losing their humanity in this economic exchange. And that's very discouraging for a customer. And you're going to start losing your business that way if you're going to treat it like that. Remember that your job is not to serve your employer. Okay, that's called just making a paycheck. And if that's what you're going to do, okay, then you're going to be beholden to that employer for your paycheck. That's just not a way to make a living. Your job is to serve the customer, the end user of this benefit or product that you are providing. That's what's important. And if you feel that is not what you're doing, you may want to take another look at this job that you've got, okay? Because maybe you're headed down the wrong path. Okay, but I'm going to assume you're going to be on the right path. And you're starting to see a reservoir of income build up. That is always a good thing. Okay, but you don't want to let that income just sit there and have no investment return. So we're going to get into some of these investment terms so you can get an idea, especially in your job. Once you start to get to a more permanent position, you're going to start to get some of these benefits, and you need to be paying attention to them because this is part of your paycheck. It's just a deferred part of your paycheck. It's something that you may not see until you're retired, or you may not see until the investment comes back as a return, say if it's a stock market investment. So you need to pay attention, because this is how you grow your money. All right, a traditional IRA. Let's just go through these terms. A traditional IRA, investment retirement account, that's what IRA stands for, uses pre-tax dollars to invest, and then the earnings grow tax deferred. At the end, when you're going to take them out and make withdrawals from this account, then it's going to be taxed because it went in untaxed. So they're going to get their tax money, okay? And they're going to take it when you withdraw those funds. Now, with a Roth IRA, it's different. You're taking funds, income that has already been taxed. The federal income tax is already being withdrawn from that income that you made. So it's called after-tax dollars. And when it comes time to take that money out, all the earnings that you got, in other words, the investment return you got on that money, and the original principal that you put in there, those are taken tax-free. And you can do that starting at the age of 59 and a half. Annuities. What is an annuity? It's a long-term investment issued by an insurance company. So basically, when you retire and you qualify to take this annuity payment, it's a fixed sum of money that's paid to someone each year for the rest of their life. It doesn't matter if they live to be 60, 70, 80, 90, or 100 or longer. That person is going to get a paycheck every month because they're going to divide it up over the year into monthly payments. And I put on here that it protects from outliving your income, because if you're saving in an IRA or any other kind of retirement account, well, that's going to be a fixed amount. If you live long enough, you could outlive how much money you have in there. And so the money runs out and there's not going to be any more payment. An annuity is like an insurance program to where it ensures that you're going to have income for the rest of your life. Okay, not a bad deal. All right, a lot of government agencies provide this type of retirement benefit. A pension acts much in the same way, but this is an employee-sponsored regular payment that's going to be paid out to the employee in retirement. And a lot of times these things are taxed. Pensions really have gone to the wayside in the private sector. There are not a lot of people offering pensions. These are pretty much more so offered in the public sector jobs. Okay, those were pretty much retirement investment terms. Now we're going to talk about just general investment terms when it comes to the stock market. And what is a stock market? A stock market is a stock exchange location where brokers and floor traders are buying and selling shares of company. They're selling the stocks or the ownership. Or it might be a public bond. It's like a school bond or a city's bond. And it's just a continuous auction house. Every day they're trading these things. And examples would be, and you're probably very familiar with the New York Stock Exchange in New York. In London, it's called the London Stock Exchange. In Europe, it's the Euronext. Okay, what is a stock market index? Well, that's going to be a measurement of a section of the market. And it's a computed average of stock prices. And it tends to indicate current market conditions. So you can get an idea of, okay, where is this particular part of the economy headed? How is it? What's the health of that part of the economy right now? Examples of stock market indices are the S&P 500, which stands for Standard & Poor's 500, the NASDAQ, the Dow Jones Industrial Average. All right, and what are stock symbols? And that's just that little ticker symbol that you see panning across the screen. It's an abbreviation used to uniquely identify publicly traded shares. So when you're having to look up a particular company, well, there's a lot of companies. And so what they do is they give them an abbreviation so that they can give a quick description of the company and the price that it's at, because this stuff moves at light speed. And you just need to be able to quickly identify it and not use up all these other characters. So for Apple computers, it's AAPL. All right, last one here, capital gain or loss. That is going to be the profit or the loss that you're going to have from the sale of property or another investment, like a stock. Taxes are typically levied on the gain or the loss, not on the principal amount that you invested. So that was probably after tax money anyway. So what you're going to be taxed on is just what you gained from it. So let's say you paid $50 for a share of Apple computers, for ownership in a share of Apple computers. You got that stock. And let's just say you bought one for an example. But it did extremely well. And so now you're going to sell it because it's worth $80 a share and you want that $30. You want to preserve that. You don't want that stock to go back down, and then you're going to have to sell it for you're only going to sell it for $60 and you're going to have lost on that gain you had that was $30. So when you go to sell it, you're going to be taxed on the $30. You bought it for $50. It increased in price to $80. I mean, that's the great thing. Your capital investment had a gain. Okay, you gained some profit from it. So it's worth $80 now, and you're going to sell it and you're going to get the $80, but the gain you got from it was $30 because they're not counting your original investment. And the same is true when you have a loss. Let's say you bought one stock of Apple computers, and again, you bought it for $50, but they had a terrible year, and now their stock is only worth $30. Well, when you report a loss, and sometimes this is good, it can offset another gain that you're going to have to pay taxes on. So if you bought it at $50, and now it's only worth $30, your capital loss is $20. Okay, and again, that's beneficial sometimes when some people will, at the end of the year, they will look at their gains and they will have other losses that are significant, and they're saying, you know what, I'm literally going to cut my losses at this point because I'm going to take the losses there, that's going to offset the gains, and I'm not going to have to pay as much in taxes this year. A lot of people play with their numbers before they end up filing that tax return so that they can have the maximum benefit of not paying taxes because their losses offset their gains. All right, go ahead and take a break. When we come back, we'll be talking about the private and the public sector employment opportunities. Okay, I want to kind of touch on where your career might be driven. You can go into the private sector and get employment that way, and this would be getting employment through private businesses or corporations, law firms, accounting firms, maybe a technology corporation. That would be the private sector. Your other options might be in the public sector. You might be going into the military, or you may be going into civil service, which might be at the city, the local, the county, the state, or the federal level. Your other option might be to be self-employed, that you're going to start your own business. You're going to go the entrepreneurial route and own your own business. So let's go through those two sectors, the public and the private sector, and we're going to be talking a little bit about salaries and how you can grow those salaries and how you can invest in your retirement through those employment opportunities. Okay, let's start with the private sector. Let's say you've gotten some kind of degree. Maybe you're an engineer and you're going to go to work for a technology company. What are your salary expectations? Because they may ask you this question when you interview. And it doesn't matter whether it's an entry level job or you're moving up and you're trying to advance into a higher level management position at even a new firm. You want to make sure that you understand what the salary is. Now, you can't just go by whatever the professor said in college, like, hey, once you're out of here, you're going to make $200,000 starting salary. Okay, that's not where you get your information. You need to dig down and look at things on the local level. You go to the geographical area that you expect to be employed at. You need to make sure you're going to that geographic area, because if you start your search in the wrong area, you could be off by 10, 20, 50% in terms of what your salary expectation can be. They may ask you point blank at that interview, what is your salary requirement? And actually, I find this question to be very offensive. I mean, it's their job to offer you a salary. You should not have to go there and propose one. But nevertheless, when you go to that interview, you are entering into a negotiation at that point. You are trying to convince them that you are worthy of being hired, and they are trying to convince you that they are worthy of working for. And so that exchange is going to happen the minute you step out of the car at that location. Okay. Second, typically private industries are going to be offering a lot of benefits to you because they're trying to attract you as an employee. And so you want to look for things that they might be offering, because these are basically extensions of your salary. Things like dental plans, vision plans, some kind of health care insurance. Okay, this is a huge one because health care expenses today are outrageous, just flat out outrageous. And it, depending on your job and the health insurance benefits you may be receiving from this employer, are going to have a huge impact on your economic condition. So make sure you're checking that out. They may offer a great plan, but if you've got to pay half of that, $6,000 a year premium, go ahead and subtract that $3,000 from your salary, because they're going to be debiting this from your paycheck before you even see your money. Okay, there's other things that typically go along with it. They're probably going to have some base life insurance plan, or they'll have options for you to purchase larger plans. Typically, dismemberment and disability insurance. Sometimes, now they used to do this quite a bit, but now education is so expensive. I really am not too sure how much of this is going on anymore. But don't hesitate to ask about higher education funding, because sometimes they're looking to keep you there. They don't want you running off to grad school and leaving their job. They just got through training you. You're up to speed. You're doing well. You're contributing to the business. But then you decide, well, I'm going to get a graduate's degree, and I need to take off to do that because it takes too much time. Well, they may offer funding for you to do that and to go to night school and keep your job at the same time. So if you want to take on that extra work, and stay in your job, you could possibly get that education paid for by the company that you're working for. Okay, the biggest attraction that private companies are going to offer you is going to be some kind of retirement benefit. Most of them, if they're large enough, are going to have some kind of 401k retirement plan. And remember, the 401k is like a traditional IRA. It's an income tax deferred deposit that you're going to make. And you're going to make these payments as an investment into a retirement plan, which takes the form of a retirement savings account, and it's sponsored by your employer. So your employer is choosing how this 401k account is going to be funded, who's going to be managing this account, what kind of mutual funds are going to be in there, and that is something that the employer is choosing for you. Now, you can go in, you probably have to go through human resources to get details on this, but they should be telling you up front what kind of plan they have. And of course, all of these private sector retirement plans are going to be, you're going to have to pay taxes once you start withdrawing these, because typically the money's going to go in tax deferred. So they're going to want, the IRS is going to want their money, and it doesn't matter whether you retire at 55 or you retire at 70, they're going to take taxes out of your retirement check. If you choose to retire early, one, you're going to have money in there. But if you withdraw it early, there's a 10% tax penalty for doing that. And that's the tax penalty. Now, if you had some kind of pension with your employer and you took it out early, there you're just not going to get as much as you would if you'd have waited until the recommended retirement date that the company had set. So that's different because that's a pension plan. But know that if you retire early, you're leaving money on the table. All right, now there may be a vesting period, and that's a mandatory employment length of time before the retirement plan is owned by the employee unconditionally. And basically, this usually affects an employee when they're matching the funds. Employers will use this opportunity to do this fund matching in your retirement plan as a way to kind of attract you to the business, because it's a way to extend your salary. If your employer is matching funds, you know, the employer's saying, I'm going to put a cash deposit into your plan that could be as high as 3% of what you're getting paid. Now, that's a 3% raise, so don't turn that down. Take the retirement plan, because usually it's an option to you to get on one of these retirement plans and get involved in one of these. It's not mandatory. So, but if you're not taking it, you're not going to get these matching funds, okay? You have a lot of benefits for doing it, because basically this is going to be a raise. And remember that when you're getting these 401k accounts, sometimes you're choosing what mutual funds you're going to be investing in. Like, you're going to have an opportunity to choose between certain plans. So you need to educate yourself about them. Talk to human resources. Tell them to give you specific explanations about what you're investing in. Okay? Be knowledgeable. Get the information. Don't go blind into this thing, because it does matter. Okay, and in a mutual fund, what that is, it's an investment program that trades in diversified holdings, and it's professionally managed. What does that mean? Well, they're doing a whole spectrum of investments. They're not just putting everything into, one company. They're going to do like a spectrum of companies to keep the thing balanced and diversified. And also, there's someone professionally managing it. That means there is someone looking at the stocks, looking at the investments, and they may be changing it or tweaking it a bit, dropping some and adding some to keep this thing diversified and to keep it giving a strong return. We're not going to go too much into this, but be of the mind that some of these, especially these technology companies, sometimes they're going to offer you investments in their own business. They might offer you, like if you're working for a technology company, they might offer you stocks in that company, just flat out as a signing bonus, or, at a certain time after your vesting period. In other words, the vesting period means, you've put in the work, they've learned to trust you, you've learned to trust them, and you're vested. They're invested in you. And so they may be offering you some of these things at a certain time, and yes, you want to take advantage of that. I mean, basically, you're just getting free investments purchased for you, okay? And they're in the business that you work for, so you have a vested interest in making the company successful, and that's the whole point of them offering you those stock options. Okay, we're not going to get too far in the weeds in that, but those are great ways to just keep expanding your investment in these private sector jobs and increasing your investment returns and your retirement account. Okay, the last thing I want to touch upon on this is, over the course of your lifetime, you're going to eventually leave some of these companies and move on. Some people do stay in the same company their entire life, but a lot of people, most people, are going to be changing jobs. it's very important that you manage the situation when you leave the job. What you can do is you don't necessarily want to leave that 401k at that job. You don't want to leave all those funds there. Okay? Probably what you want to do is make sure you're taking them with you. You're going to roll over your 401k, and you may be able to roll it over into a new employer's account, or probably what you're going to want to do is roll it over into an independent traditional IRA account at some investment firm completely outside of this new job, and just have that 401 account keep going. And the IRS will let you do that. Okay, but you have a limited amount of time in which you're doing it, and you got to make sure you're following those rules. You don't want to incur that 10% tax penalty for taking those funds early. You want to make sure it's very clear that you never touched this money. It went from the retirement account at your old job into this new retirement account. Okay? Be very careful about that. Again, do not leave money on the table when you're changing jobs. All right. Maybe you're more of the risk taker and you are going to take on this entrepreneurial spirit and start your own business. Now, I highly encourage you to do these things, but you've got to be very savvy before you do that. This is a lot of risk to take on. You're not going to get all these benefits that we just talked about. Okay, there's nobody that has this set up for you. I mean, this is you deciding, I'm going to make money and I'm going to set up my own benefit situation. Now, your salary is going to be paid out of the profits that you make. Okay, so you got to always remember, if you're creating a product and you're going to put it on the market and you're going to sell it, you have to take in consideration everything that's happening here. What are you going to sell it for? You need to make a profit off of that product that you sell. And it's got to be enough product to, one, pay the corporate taxes, and two, remember that paycheck where you paid 6.2% into the Social Security benefit. Okay, it's not really a benefit. I mean, it's basically Social Security tax. You paid into that, but your employer also paid 6.2% of your income as a tax. Your employer shared that tax payment for you. Now, if you're self-employed, you're going to pay the whole 12.4%. Okay, so just right off the top of your income, 12.4% is going to go into Social Security tax. And you've got to remember you were paying Medicare at the same time. So there's another 2.9% on top of that. Your self-employment tax is going to be 15.3%. Okay, that's just self-employment tax. That doesn't include income tax. All right. Now, that's why I meant when you're looking at selling your product, you've got to keep these numbers in mind, because otherwise you're not going to have a salary left when it's all over if you don't plan for enough profits coming in to cover your salary and still make money, because you're going to want to reinvest in your business. So the next time someone says, oh, you work for yourself and you make a profit, you say, no, I'm self-employed and I make a salary. Would you like to talk about your salary that you take home in a paycheck every day? Because my salary in a paycheck is really called a profit on my own business that I created myself. Just a little pet peeve there. Now, remember, there's no benefits that typically come along with this. You got to start from the ground up. You've got to find some kind of health insurance plan that you're going to be on, or you're not going to be on one. Now, they're still charging a penalty for that. Okay, but it's wiser for you to make sure that you have some way to cover expenses in case something serious happens to you health-wise. And you're going to have to look for that. And for small businesses, this is probably their biggest problem. It's because the health insurance companies favor large companies that buy big group plans, and you can't offer them that. You're just yourself or maybe just a few employees, and you aren't competing very well in that health insurance purchase market. Okay. So you're going to have to really dig for a good deal there. And all those other ones, vision plan, if you're just a small business, if you're just a sole proprietor, you're just basically, you're not going to have those things probably. You're just going to pay for those things on your own. You're going to go to the dentist, pay him as needed. Okay. Or if you have a lot of employees, then you might be able to find some kind of dental plan or vision plan that you can take part of. Okay. Retirement plan. You're on your own. That doesn't mean you don't get one. You go to a place that specializes in retirement funds for small business owners. You find a place that's independent. You find a investment company. I'm not going to suggest any one investment company, but names of ones where you can go in and create your own retirement account. Investment companies like Charles Schwab or Fidelity, T. Rowe Price, Vanguard. There's a lot of them out there. They put together retirement plans, with mutual funds, and they build them up, ones that they feel are good, and they sell them, at a discounted rate. You're not paying for all these high brokerage fees that you pay unless you're going to get in and just start buying individual stocks. Okay, so it's very attractive to small business owners to go in and get some of these accounts and get started on some kind of retirement plan. Don't get behind on that game. Okay, you need to plan for your retirement just like a person walking into their first job. Set it up, do the work. Don't be sloppy about that. I'll put some links to some of these companies on the website so you can take a look at them. Make sure you're diversifying. Okay, that's really important to kind of spread your risk. Stocks, bonds, mutual funds, futures, commodities, foreign exchange markets, real estate. Real estate is really important. I think that should be just part of your diversified portfolio. Get some real estate, okay? And you might even have some because you've purchased some kind of property for your business, or you have a home, which is a good real estate investment. Precious metals, oil and gas, some kind of startup technology. And don't forget, your own business is an investment. Okay, you have put time, sweat, money, and maybe even a few tears into this investment. So don't undercut it, okay? Give it time. It takes a long time to get a business going. It's like trying to start a train. And this is an admirable thing that you're doing, okay? To have the spirit and the strength and the ambition to be an entrepreneur, to own your own company or to own your own small business is very admirable. Okay, there's respect for somebody who takes the risk and is successful doing that, but it will take time. Have you ever watched a train start up and start pulling all those cars behind it? Just give that train time to get up momentum, because once you start a train, if you haven't noticed, it's really hard to stop a train. Okay, that's why they blow their horn, because if you're in the way, you're going to get run over. Be patient and follow it through. That's how you be successful in your own business. Okay, next slide, and this is going to be the last slide before we take a break. All right, public sector salaries and benefits. If you're going to go into the military service, or you may just join the civil service, providing a service for a local government, county or city, or you may find employment at the state level or even at the federal level. Basically, your salary is paid by the taxpayer, and your salary is determined by your pay grade. It's very structured in the public sector. And it's supposed to be public. So if you're ever doing research about how much you're going to make in a specific public sector job, you should be able to find all of these things online. I mean, you can find pretty much anything you want. You're supposed to be able to find it online at any job that you're seeking in the public sector. So they're going to list the pay grades. And I'm going to put a couple of links on here so you can just kind of go and see where I found pay grades for like the Austin area, or the Office of Management and Personnel. That's the federal level government website. That's like their HR department. And a military example, okay, what military pay is, the Defense Department pays that. There are benefits, and I think good benefits, that come with the public sector job. Typically, government employees are not participants in the Social Security entitlement plan. They usually have their own plan. And so, like with teachers, it's called TRS. Public school teachers are on a different retirement plan. Most public sector retirement plans are pensions. And basically, what they're trying to get you to do is make this a lifetime, well, not necessarily lifetime, but a pretty extensive service that you're going to provide. At least 20 years is what they're looking for before you're going to qualify for a full pension plan. So they're going to have a vesting, and that's that vesting period, and that's what they're going to call it in the public sector. And it's typically 20 years if you want that full pension to be paid when you're at the age of retirement, like 60 years old. Or if you're just going to work 10 years, you're going to maybe work for a reduced annuity or pension. You're not going to make the same amount of money as someone who worked for 20 years. So obviously, if you're just going to work for 10 years, you're going to get a pension, but it's going to be substantially lower than someone who put in a whole lifetime's career in public sector work. Health plans, dental plans, vision plans, typically most government jobs are going to cover all of those things. Their benefits are probably the better part of their pay. The salary, the paycheck usually isn't going to be as strong as it is in the private sector, but the benefits are designed to make up for that lower salary. All right, take a break, and we will come back on the flip side and talk about how do you buy a house. Welcome back to the lecture. We're on part B, and we're going to start the topic of what is involved in buying a home. You have a job, you've got a good dependable job, and you're in a financial position to purchase a piece of real estate. Now, for a lot of people, this is the largest transaction they're going to make in their lifetime. So let's go through what's involved, because it is an extremely complex process to go in and buy a home, and it's very disconcerting. So remember that part of it, because this is going to put a lot of stress on your family. Make sure that you're accommodating your family at each stage of this game, because it is a little stressful. I mean, you're basically telling people, pick up your toothbrush, pack everything up. We're moving somewhere. We're putting a lot of money into this. We're putting a lot of time and effort. And at the same time, you're still taking care of kids. You're still trying to get your workout in. You're still going to work 40 plus hours a week. Make sure you're accommodating them and you are prepared for this purchase, because there's going to be a lot of money flying around. Okay, let's go ahead and get started looking at the different components that make up buying or selling a home. We just have the one slide here. That's all we're going to look at. Plus, I'm going to go in and do some screen recording of looking at a mortgage calculator and looking at a settlement sheet for this purchase. All right, so you and your family have spent some enjoyable afternoons probably driving around, looking at properties. Maybe you've been working with a realtor to kind of search for a property. Before you go out and do any serious looking, I would highly suggest that you go to your bank, and especially the one that you've been working with. The place where, one, you need to shop banks for their interest rates on mortgages and make sure you're getting the lowest possible interest rate. And that interest rate is going to be highly dependent on your ability, your financial ability to purchase this size of a loan. Okay, you're basically buying a loan. Unless you're going to pay for it cash, then we don't need to have this conversation today. Okay, so the big deal here is that you are taking on a very large debt, and you're trying to find a bank that's willing to make a loan to you in this amount. So it is very wise for you to go get what is called pre-qualified. Go to a bank that you can trust, that knows you. Talk with them about getting pre-qualified. You'll have to get a credit report done, probably several. You'll be needing to submit information on your income, information on the debts that you currently are paying on. All of that will be weighed together to make a calculation of what risk they're willing to take on you. And the risk is they're going to be letting you borrow this large sum of money. Okay, so you're going to go there and get pre-qualified. And what that means is that when you go talk to the realtor, you go in and you think you're going to make an offer on a home. You have a sheet of paper, you've got an email that's going to be able to prove to them that you are indeed a bona fide buyer. This is a good way to advance your position when you're going in and looking at things. Because sometimes you get into a position where they want to know that you actually have the ability to do it, or they don't want to bother with you. Because once you put this thing into motion, there is a lot of work that's being done by the seller, by the buyer, by the realtor, by the banks. There is a lot of work going on. So they want to know that you actually have the ability to buy the home. And this pre-qualification will prove that to them, that a bank has already told you, yes, I will give them a loan for this amount if they apply for it. Be ready to have a down payment available. Now, typically, a bank is going to want at least 20% of the value of this house to be paid for up ahead of time. Used to be you had to have a 20% down payment. So if you were going to buy a home for $100,000, then you had saved up $20,000 to put a down payment on the home. We have, as a nation, kind of gotten away from that obligation and that preparation for buying a home. And loans are just given out left and right. And that's why you see a lot of defaults going on, because people were never prepared to take on this type of responsibility. They didn't save up their pennies. They didn't show any discipline in making a savings amount of 20% on a home. So they get themselves into a situation and they end up not being able to support this loan and its payments. So you need to have a down payment option. If you have a home that you've already been in and you've got some equity in it, in other words, it's worth more than what you owe on it, then they may take that as a form of down payment, because you're expecting to sell that house, or you've got equity in it that they're going to borrow against. Okay, that's a lot of words and a lot of concepts, so I'm not going to get in the weeds with that right now. Get pre-qualified. Understand that this next thing on here, the loan to value ratio, that's the amount you're borrowing divided by the appraised value of the property. And you're saying, what? Okay, what they want to know is that there is at least 20% invested in this home. There's 20% of the value already paid for on this home. Someone's got some skin in the game. The bank is going to take the amount you're asking to borrow. Say you're asking to borrow $80,000. Okay, they're going to take that and they're going to take the appraised value of the house. And let's say the house is worth $100,000. They're saying the loan to value ratio is 80%. You are not borrowing any more than 80% of the value of this home. And the other part of it, however that happens, is already paid for. Either you made a down payment or you made arrangements for an equity loan, which they're willing to do. However it is, that bank knows that there is already 20% of the value of this home paid for. And what we talked about was it was the appraised value of the property. What's going to happen is the bank is going to expect you to pay for an appraisal on this piece of property, on this home. And they're going to have an expert come in and do an assessment of the home, a financial assessment. They're going to estimate what the market value of that property is at that time. And this is usually done by going in and comparing similar properties. So they might go in the same geographic area, like maybe the same neighborhood, and find a home that's the same size. Maybe it's a 2-bedroom, 1-bath home on a quarter acre of property. They're going to find a home that's similar in size to the one you're going to buy. And they're going to look at the price, and maybe it just recently sold. That's what's very important, is that a recently sold property is showing what the market value is of it. So they're going to look at that, and they're going to get several of those. They're probably going to get 2 to 3 of those. And so they're going to take the recently sold ones, and they're going to compare it. They're coming up with an estimate of what your home is worth at this very time that you are considering buying it. All right. Interest rates. These change, obviously. So, at the time that you're watching this, you may not necessarily look online and find this to be the current interest rates. They're rising a little bit. The Fed is raising its prime lending rate, and so that's what makes these interest rates fluctuate all the time. They're constantly changing. So you want to make sure that you're aware of what a good interest rate is, because that's what you're trying to target. It doesn't take 3 seconds to do a search online and find out what the current interest rate is. Usually you're looking at a rate that's at a 10-year loan, a rate that's at a 15, a 20-year, or a 30-year loan. 30 is about the maximum you're going to see. I suggest you don't base it on 30 years. Okay, that's way too long to be paying off a home. Most people are not staying in a home that long. So I would suggest you kind of take it on the chin and you'll get a better rate if you get a lower term. So if you go in and ask for a 15-year or a 20-year term, you're going to get a better interest rate, okay? Because they know you're going to be taking on more of a payment. Your payment's going to be higher. And so they know that you've got a vested interest in that. That you're going to be more willing to pay it because you're trying to pay it off early even. Just that decision right there gives you some credibility, okay? It gives you some credibility in terms of the bank saying, hey, this person is being responsible. They don't want to just get the cheapest, lowest monthly payment that's going to be available to them. Okay, and I put on here emergency savings of 6 months. Typically this doesn't really come into the conversation of selling a home, but at this point, you should have been saving money. You should have a substantial savings in the bank. Have an account put aside that has 6 months value of the paychecks that you have coming in, just for emergency purposes. Okay, that's just a wise thing to have. There are several tools online to help you go into this process of buying a home and just run some numbers for yourself. Okay, a good way to do that, and it's also like a good checklist for you because you're starting to think about, okay, what will my other home sell for before I buy this new home? What kind of loan am I going to expect? And then also the big thing is, what is going to be my monthly payment? So let's look at a mortgage calculator. I'm going to start a screen recording, and we're going to talk about different scenarios that you might be, that you could kind of look at to manipulate how much you're going to take, what the term's going to be, etc. Okay, so let's look at that. I've got the website open, and this is www.bankrate.com, and they've got this calculator that you can kind of get an idea of what your monthly payment's going to be and what your expenses are. So they've got one set up here for a loan amount of $150, but we're just going to play with these numbers. And up here, you've got your, once we put some new numbers in, we're going to calculate it, and then we can view a report so you can get an idea of exactly what you're paying. All right, let's say that you're going to be modest and buy a home or take a mortgage of $100,000. Okay, and your interest rate, now this looks a little low to me. Remember, we were looking at interest rates and they were, between 4 and 5%. So let's make this 4.5%. Okay, and you can see the number up here is changing as I do that. And you're going to be a good loan buyer, and you're not going to do 30%. As a matter of fact, we're not going to do 30%. We're not going to do 30 years. We're going to keep this here at 20 years so that we can get a better rate. Maybe this little rate might go, it is lower probably because, you took the 20-year, not the 30-year. And down here, you're kind of putting in information. This is your value that you're putting. You're coming and saying, I'm a legitimate home buyer. I'm a bona fide loan taker because I make this certain amount of money, but $20,000 is not a good income. So not for buying a $100,000 house. I mean, obviously, you're going to have difficulty doing that. So let's take a modest income of like $60,000. And maybe that's just, your spouse is a stay-at-home parent, and you are the only one working, and you, at this point, are making about $60,000. So you've just got one source of income. Okay, now if you and your spouse put your incomes together, then obviously that's going to be two sources. So that's going to be a 2. But we're not doing that. We're saying there's one source and you make $60,000. They're going to want to know, well, how much is going out the door of your income? Well, if you've got $2,000 a month going out, that's a lot of payments going out. Okay, so you don't want to you want to pay off debts before you buy a home, so that you don't look like somebody who is going to default, the first 3 months of their home mortgage. So pay off those debts before you try to go in and ask for a pre-qualification. Okay, make sure you're doing that homework and taking care of that business. All right, so we're going to put this down here, and we're going to say, okay, I think it's fair to say you have, $400 a month that you pay on existing debt, like a car. That's not even very good. I'm going to make that 500. Okay. A car, maybe 2 cars. You've got some credit cards, Christmas loan or something. So your total payments are $500 because you're only making 60. Okay. So you're trying to keep the best image you can get going here. Now, they're going to look at your credit history and they're going to see, well, what's the potential for them getting into debt? Okay, now if you've got credit cards on there that you could potentially run up to $100,000, that looks like a problem to them because you could still potentially do that after they give you this loan. So if you see down here, your approval is looking very good right now. We're in the green. Okay, because you could only charge up to $30,000 on a credit card, but you're making $60,000 a year, and you're only asking for a $100,000 loan, and you're being frugal about it, and you're going to try to pay it off early at this 20%. So, but let's put in here that you have the potential, because you've taken out a bunch of credit cards with high maximum rates that you could charge, and let's put $100,000 in here. What I did was, let's go ahead and I went ahead and calculated it, and you didn't see that on the screen, but it lowered it basically went in and it lowered your likelihood. And what it's saying here is, however, the ratio of your loan amount of $10,000 to your real estate security value is 83%. So it's over 80%. Okay, and loans with this ratio over 80% but less than 95% may require the purchase of a mortgage insurance. That's the PMI I was talking about, and that ensures the qualification for this loan. Now the reason why this should be 80%, but you've got this right here, and this is killing your situation. Okay, now you combine that with the fact that now you've only got your property's only worth $100,000, so this is going to kill it, because you're basically taking the total value. You have nothing invested. You have no skin in the game. You don't even have $1 invested in this house already. There's no down payment. Okay, you're not going to get a loan. You're most likely going to be declined. Okay, so you got to play. What they're doing is they're calculating how much this is going to impact this, and that you're going to have you're going to have a higher loan to value ratio, because you're probably going to charge these cards, and that's what triggered this. So we're going to fix this. Okay, you're going to fix this before you go into this deal. All right, we're going to say your credit card limit, it was set at $30,000. I would not put it any more than like $10,000. Okay, and we're also going to put in here that you paid $120, and we're going to, let's say it's worth $125, because we're just going to be safe here with this, not $100, not $1 million. Okay, let's try this combination. You've got your credit card limit pulled back to a controllable limit, and you're putting in, you've got $25,000 vested in this house. Okay, we're back up to you are very likely to get this loan, okay, because you've massaged all these numbers. You went in and did the homework. You're not overextended, you're not overextended. You're only paying $500 a month in pre-existing debt before this home purchase. And you don't have the potential to get into a large amount of debt, because you only have $10,000 that you can charge on your credit cards. And so that kind of gave that wiggle room by putting in here that you put down $25,000 into this home already, and that's how much you've got vested. Okay, you're in a good loan situation now. Okay, so now you're in a good position. Okay, you have done your homework, and you have these numbers correct, because you've done all your calculations, and you're ready. You know going into this how much you want to ask for, how much you need to put down, where your credit needs to be. And now, well, this is great. I mean, you've got a $100,000 loan that's going to have a $633 payment. Now, remember, you're going to have property taxes added onto that. But, okay, this all looks great. Now, I want to show you another great, important feature on this website, this calculator. View the report. Okay, first of all, big green light here. It's showing you the summary that you're gonna get this, and you're not gonna have to pay any PMI, because you've put your skin in the game. You've put $25,000 of value, cash probably, into this house, or it's worth that much. Okay, and it's telling you your term is 20 years. And the interest, this is important. The interest, if you make all the payments, you're going to pay, this is kind of a shocker, you're going to pay over $51,000 in interest over the life of this loan. You're going to pay $51,000 in interest up and above what you're paying on the principal. That's what happens when you take a loan, okay? That's what the bank gets. They get $51,000 as payment for giving you this loan for 20 years. Okay, you can imagine how ridiculous this would have been if you had gone in and done 30 years. Okay, so we'll look at that in just a second as an exercise. But this right here, the payment schedule, this shows you how much your principal, how much of your loan you're paying off with every payment. So let's go to 36 payments, which is going to be 3 years, because it's 12 payments a year. Let's say these are monthly payments, and you're at the third year, and you've paid off 3 years. Okay, and obviously this number is going down, this amount of interest that you're paying every month, because the principal's going down. Now you have $90,000 paid on this loan, okay, at 3 years. So you can get an idea of where you're going to stand in terms of how much equity you have in this house. Now let's go to, if you go down here, it's going to show every year up until the last year and the last payment you're going to make to pay off this house at 20 years. but let's go here somewhere. Let's go to 120. Let's go to the halfway mark. Okay, at halfway, at 10 years, you will only owe $61,000 on this home, okay, because you're paying it off every month. This is just a great, valuable tool to get an idea of where your money's going and when you're going to be. At that point, you've got a lot of equity there. You know, okay, let's go back to the 120. At this point, at 10 years, and I told you, hold on to your properties. At 10 years, you now have $40,000 paid off on this loan, nearly $40,000. Okay, and you only owe $60,000. But most likely, the value of your home has risen from that original $125,000 to $200,000. So you're looking at $140,000 in proceeds if you were to sell this house, because you only owe a little over $60,000. Now remember, there's expenses involved, so you're not going to get that whole $140,000 trying to sell this house. But it should give you an idea of the beauty of real estate investment, okay? Because it goes up in value and you're paying on this loan, so what you owe goes down. Okay, I don't recommend it, but there are home equity loans that you can get on this amount to pay off other bills, maybe school loans, et cetera, et cetera. But this is how real estate investment works. It's a really good investment if you do it wisely. Now, I'm going to show you one more thing. Let's go back to the calculations. We put on here 20 years, which was a good conservative amount. I'm going to put 30, because a lot of people do 30 because they want, this number is going to go down. This monthly payment you're going to make is going to go down. Do you see how it went down to $507? You're thinking, great, it's $507. You know, now I've got an extra, $120 that I can play around with every month. Well, let's view the report. And I want you to pay attention to one specific thing. You're still likely to get this loan because a lot of people do it and they don't really penalize you too much for taking the 30-year loan. It's fine for them, and let me show you why. Right here. The bank is going to get $82,000 in interest payments. You're going to pay 80% of the value of this home in interest to the bank before the life of this loan is over in 30 years. Do you see how this went up dramatically? I mean, I think that was $30,000. I think it was 51 before, correct? And now it's 82. You just increased how much you're going to pay that bank in interest, $30,000 by putting on a 30-year loan. And no one noticed anything because they said, you're fine, you're good here. You've got... you're going to get this loan. If you want to take it for $30,000, that's fine. They love that because look, they're going to get $30,000 more. Okay, this is massaging the numbers, and this is getting this loan evaluated, and you know where you stand. I'm going to go to 120. Okay, at 120, remember you had paid off this. With the 20-year loan at the halfway mark at 10 years, you paid off $40,000. Well, here you've only paid off $20,000 at the 10-year mark. Okay, and so you lost out big time, not only here but all your money that you were paying off with the 20-year loan went here. You paid interest and $20,000 and gave it over to the bank. Okay, ridiculous. It just, by changing this one number, look at the huge difference it makes in how the money is getting split up. It's going everywhere but to you. All right, you've got to be very careful with the terms of these loans. Take the lowest term you can possibly take. And I am going to do one more thing. I'm going to make this a 15-year note. And let's see what happens here. Okay, remember it was like 633, so and it went down to 507 with the 30-year loan, but now we're at 15 years, and your payment went up. Okay, it went up about $130. You can handle it because the beauty is going to be this. Look, they're only getting $37 in interest over the life of this loan. You just lowered that significantly, and we're going to go to the 10-year mark. Okay? Beautiful. You only owe $40,000. This is real estate. It's beautiful because everything gets inflated in terms of price. If you do it correctly, your profit gets inflated. Okay? Not everybody else's pocket. So do this transaction well. Do your homework. Okay? Look at the numbers. Use these extremely valuable tools online and use them to your advantage. Educate yourself before you make this transaction. It is the most important transaction of your life, and it means so much to your family. To have and own their own home, to have the security, and to know that in the future you're making an investment. Cars are not an investment, okay? They're terrible investments. Homes are excellent investments. And when they're done wisely, pay off in beautiful dividends. Okay, that's the mortgage calculator. All right, so let's move on to this next topic. You're going to start entering this negotiation period. Now, you think you're going out, maybe after church on Sunday, and it's a beautiful day, and you've been thinking about buying a home, and you and your family have some lunch, and then you say, let's go look at some houses. It's fun to do that, right? You're going to go out, and you just kind of stumble on some builder's construction site, and maybe you're going to go in and look at one of the homes that they've put together so that it can be walked through. It's all beautifully decorated. I mean, keep those things in mind. Someone goes in and makes it look absolutely gorgeous, with furniture and paint colors and such and such. So remember that you're looking at their best product right there. Don't get distracted by the staging that they're doing. It's called staging. They go in, they set the lights real pretty, they put on some nice smell stuff in the house. They've maybe got the TV going, and there's some big cushy couches there, and it's looking very inviting. Okay? But remember, those things are all just staged to make your experience in this home very pleasant. And that's fine, but you just want to keep that in mind when you're looking at properties. So anyway, you're there, you're having fun, the kids are outside playing, and you're thinking, well, I kind of like the way this house is laid out. And what you do is probably a salesperson's going to come up to you, or the realtor is going to start talking to you about, well, what would you be interested in paying for this home? Or do you think that you can pay what this builder is asking for this home? And these conversations are going to get started. Do a little homework, and it doesn't take a lot of time. You want to look at comparable properties. Remember when we talked about the appraiser doing that? Well, they're doing their due diligence and finding out what is the actual value of this home. Take a minute to do that online. There's some great websites now. I mean, you used to have to really dig for this information. But now there's like a website called Zillow where you can go in and look at comparable properties. These are deeds that are being put into some kind of county database. So their public information is out there about what was paid for this property. You may be in a position where they're starting to ask questions. Okay, so you want to have some answers, or at least have some thought process of what you're willing to pay for and what general market you're in. Okay, and maybe in this situation, you're not the buyer, but you are in fact a buyer and a seller, because maybe you already had a home, you already went through this process, and now you're going to sell your home before you buy this new one. You need to be very aware of what's going to happen on that transaction and have that ready to go. I mean, I don't think there's any time in anyone's life that is more stressful than trying to sell a house before you buy a house and wanting to make all that happen at the same time. That is extremely stressful. But if you are indeed going to be a seller in this transaction as well, be aware of the fact that things that are going to happen on your home that you're selling. You may have a realtor that says, hey, I'll take care of everything. It's no big deal. Okay, they've got it all done. You've cleaned it up. You've made it all nice and staged the home yourself, and people are starting to look at it. Let's say someone's going to make an offer on your home that you're selling. You need to be very aware of the fact that they're going to do a home inspection on your property. This home inspection is paid for by the buyer. The home inspector, whose pocket are they in? Well, they're in the buyer's pocket. Okay, so it's their job to go in and find things that are wrong with this home that are going to cost you money to fix before you sell it. That's going to be part of the negotiation. And I guarantee you, they're going to go over and above the call of duty on this. And they're going to come up with stuff. And they're going to say it has this, and it's got water damage, and it's got this. If they can find anything to pin on your home, they're going to do it with this home inspection. And that's why I put the big yellow beware of the home inspection, because you're already have probably accepted an offer on this home, and now someone's coming in and examining the home. And they're saying, you know what? You've got $20,000 worth of roof repairs to make here. If you're willing to, take that off the price, we'll buy the house. Those are the kind of stressful situations that happen after a home inspection. And on top of that, on top of the home inspection, if this buyer decides, you know what, I'm going to get out of this situation, I do not want to buy your home, the home inspection sticks. So if they declare that there is water damage in the home, there is termite damage in the home, there is structural damage in the foundation, that home inspection report sticks, and every buyer that comes in looking at your house gets to see that home inspection and gets to and look at it. And I guarantee you that's going to be a big black eye if you've got some major damage in your home. You will not be able to shake this from your selling process. So beware of that. That is a big trap that a lot of sellers fall into. They go in, they think they're going to cosmetically cover up some kind of major damage. And what happens is they get a big, fat home inspection disaster that just gets plastered on the front of their home they're trying to sell. And the other thing is, when you're selling, just take the price that you're selling it for, the lowest price you think you're going to get for it, and just say 10% right off the top is going to be my cost for selling that home. So let's say, for instance, you have a home valued at $200,000. You have paid it down some way over the years, but you still have a mortgage to pay off, and that's $100,000. But you've got $100,000 of profit coming from the sale of this home. Well, take that $100,000 and just take off 10% of that. Take off 10% of the home, which is, if it's a $200 home, call it, $20,000. So really, you're not going home with $100,000. You're going to probably go home with $80,000. You got it? Because there are just so many expenses. If you're a seller, you're paying for one of the biggest expenses is the brokerage fee. You're paying for the buyer's real estate agent, and you're paying for your real estate agent to sell it. That's 6% right there. Okay? Then there are just fees on top of fees on top of fees that you're going to have to pay for. And we're going to go through that in this settlement sheet that we're going to look at in a minute. Okay, you're building a home. First of all, God help you, God be with you, because this has got to be one of the most difficult transactions and periods for a family to go through. And it sounds rather dramatic, but you need to understand there is so much involved in this process of building a home. There are a lot of people in here, and just take for granted that some of them are trying to take advantage of you, and you're just going to have to be constantly like a hawk, watching this process to make sure it's being done well for you. If you're doing your own design, and you may have to go in and get some permits taken care of. Permitting alone can take forever. I mean, these local governing agencies set up permit process, a building permit process that is just so cumbersome. You've got to only can have this much square footage, and working in Austin, Texas, it can only be this much square footage. It has to look like this on the front. It has to be set back this much from the road. It can only be so high, and it can't stick out this much, and it has to be better than square. Just they called it the McMansion rule. Once they codified, made into, quote, law or a regulation that you had to have, you had to stay under a certain height and square footage, and, you couldn't just have a square there. You had to have some, different wall setbacks and everything. Once they did that, it was Katie bar the door. You now in Austin, you can't paint your house, replace a window. You can't do anything without a permit. You talk about putting someone's building on a permanent process of reevaluation and waiting and cost. Permitting can be an absolute nightmare, and sometimes it just shuts down the whole process. Keep that in mind if you're building a home. Now, a lot of times, if you have someone doing, the architect or the builder will be taking care of this for you, but realize that if you're building a home in an area where they have a lot of permitting problems, this is going to increase the cost of your home, because they are dealing with this and it's costing them hours and money to do it, and they're not doing it out of the goodness of their heart. It's going to come down on that ticket when it comes time to buy the house. All right, financing. You got to do financing. You're doing an interim loan, and it's a construction loan, okay? And then, the bank is paying the contractor to build the loan in phases. Okay, they're going to give them $50,000 to do this part, and the foundation maybe, and then they're going to do $50,000 to frame the house. So, this is it's called an interim loan, where you've got a short-term loan, maybe it's 6 months. The builder is building it, and you're really doing nothing. The bank is paying them a slow feed of money to build this home. Okay, realize that your time involved is going to be significant in just making selections. When it comes down to it, sometimes the builders will take care of all this. But if you're doing a custom home, your spouse are going to want to say, hey, I want the home color to be this, the paint color to be this, on the outside I want it to be this on the inside, and hey, every room's going to be different. I want this type of lighting, I want this type of wiring in the house. We want to have it wired for security, we want to have internet wiring. It just goes on, and it seems like and you have to make decisions. You're just making decisions at every turn. Okay, and then also, you've got to get this timing right. Maybe, God forbid, you're selling a house at the same time. You've got to sell it, but you don't want to sell it too soon, because then you're going to have to move into a temporary home while you're waiting for the home to be finished. Okay, so there's a lot of moving going on here. You're going to move from your house that you've been in, or your apartment that you've been in, into a temporary thing because the construction's not done. And believe me, the timing of the construction will never be right. It's very rare that you don't have this weird interim period where you're living somewhere else until they finish their job, because a lot of times that you don't want to be hanging on to a house and moving into another one and have these two mortgages going on. Okay, that's something you've got to be aware of. That's expensive. Getting a short-term living situation is very expensive. 6 months in an apartment, you're going to pay for that, okay? They're usually going to want a 1 year or 18 months lease on that apartment or that home or whatever. So it's really hard to get like a month-to-month lease situation. You can find them, but you're going to pay for them. That's what I'm saying. You're going to pay for those months that you're leaving it up in the air as to when you're going to move out. Okay, and don't undersell the fact that this interim living is stressful. Okay, it's stressful on your family. Everything that they own, from their toothbrush to their clothes to all their toys, is all being moved. It's in a box, and then the box is just sitting there, and then they got to unload the box. You can't find anything. You're in this interim situation. You got pets you got to consider, and you're in an apartment now. I mean, there's just so many decisions to be made, and this is all just temporary. Okay, so interim living, that's going to be that the part is going to be stressful on the family. That's the psychological stress I'm talking about that is going to eventually move from just you doing this transaction to your family now experiencing it. Okay, you've decided you're going to buy the house. So let's talk about what happens once you put that spark in the fuel. Okay, all right, you've decided you want it, you make an offer on it. When you make an offer, you need to realize that you're going to be entering into this period called an escrow period. And that just means everybody's in limbo. The buyer's in limbo, the seller's in limbo too, because now it's off the market and that seller can't sell it to anybody else at that time because they've engaged into this escrow period where, nobody else can make an offer, and that protects you as a buyer because you don't want someone coming in and undercutting you. I mean, that doesn't work. You're putting a lot of investment into just this escrow period alone. So everything goes on hold. Both parties go on hold. And then a lot of stuff starts happening. Okay, you're going to have to put some money down for that. Typically $1,000, $2,000. What you're doing, it's called good faith money. It's what you're saying is that, yes, I fully intend to buy this home at the end of this escrow period. And if I don't, the penalty I'm going to pay to you for taking your property off the market is $2,000. That's what this good faith money is, this check that you're going to put down. And it's called an earnest money check. It's paid by the buyer to the seller, but it's held by a third party during this escrow period, which is basically a negotiation period. Okay, it's going to be held by a third party, and then if you do decide to buy the home, then it's like kind of like a down payment. They're going to deduct that amount from the cost of the house. In other words, it's going to be like as if you paid $2,000 towards the house. But if you decide that you're not going to buy the house, okay, you've put a lot of expenses on the seller. And basically, your penalty for doing that is this $2,000, and the seller's going to take that and go, hey, it was off the market. I had to pay this. I had to do this. I had this done. I get the $2,000. Now, you can get out of this escrow period with your earnest money for a lot of reasons. Okay, it's not like you're going to give it up. And remember, the buyer wants to know that you're a good buyer. Okay, that's what the pre-qualification does for you, because they may say, you know what, I don't want to sell it to you. You just look like you haven't showed me anything that's going to tell me you can actually afford this. You're going to end up bailing on me. My house is going to be off the market for such and such time. So that pre-qualification letter, that's where that comes in to be very valuable. You're handing them something that says, yes, I am a bona fide buyer. I have the money to do this. And if I decide to buy this house, I can actually make this financial transaction occur. Okay, so you're in this escrow period. Okay, both parties, the buyer and the seller, are supplying the realtors. And the realtors they're the navigators of this situation. And it really helps to have a navigator. They get a lot of money. They're going to get 6% of this sale between the two of them. And that's where they're getting paid because they're doing all this footwork. This is where the realtors and the title company come in and they start putting together this sale. You're entering into a bona fide effort to buy this house, and the seller is expecting this process to be completed. So this is the limbo period, okay? Escrow. Purchasing the house, a few things you should know. The brokerage fee. Typically, the seller is going to pay for your realtor as the buyer. Okay, they're going to pay for 3% of the cost of the home. So they're going to get, the realtors in this case, the buyers and the sellers are going to get, each going to get typically 3% of the cost of the sale of the home. So if you're selling it and you finally agree on an amount of $200,000, they're going to get 3% of that each. Okay, the survey. Typically, unless you've done some improvements to your home that have changed the footprint of it, the survey you got when you bought the home should be available somewhere. Okay, and you need to dig that up and get that, make that available to the buyer. Okay, if you are the seller. And as the buyer, that'll be part of the process. The survey is going to be done. There's going to be an appraisal done. Remember, we talked about that. There's going to be an appraisal of what is the market value of this home. That's going to be done, and you're probably going to pay for that because you're the one getting the loan, and the bank is the one hiring the appraiser to go make sure this home is actually worth what you're buying it for. Now, sometimes that's a problem because you might have an appraiser go in there, say you just love it so much and you kind of got snookered. And you didn't do your homework, you didn't go to Zillow, you didn't compare properties, and you kind of went in on a $100,000 house and you said, yeah, sure, I'll buy it for $200,000. Well, the bank's going to say, I can't give you a loan for $200,000. This thing is only worth $100,000. That's a showstopper right there. Okay, that's not a good place to be. That's why doing your homework ahead of time is going to help you with all these little things that are happening. And one of the big things is this appraisal. You want that appraisal to come back correct for the amount that you're offering to buy this house for. Loan origination fee. The loan origination fee is basically the commission that the loan officer gets for conducting this transaction for you. And that fee can be either 1 to 2% of the value of the home. Title fee. This can be anywhere from $1,000 to 1% of the price of the home. So the title company that is doing this whole clearinghouse exercise, between the buyer and the seller and what are the fees and who gets what and what bank gets how much and who paid what fees, the earnest money check, all that's coming down, going to come out in the wash on this settlement sheet that we're about to look at. Okay, so they're going to get a fee for that. Not only are they doing that, they're going and doing a search on the title. That's why they're called the title company. But also, the title to a home says you, in fact, have a legitimate claim to the ownership of this property and this house on this property. That's what gets registered down at the county, okay? The title to the property. Maybe the person that owned it didn't pay their property taxes, so there's a tax lien on the property. Sometimes you've got, you could just have a contractor's lien against the home. Say the owner that you're buying it from had some work done and they didn't pay the contractor. Well, the contractor has the right to go down to the county office and file a lien against this property. That's another lien threat to the property. The title company is searching and ensuring that there are none of these liens, that there are no legitimate claims to the ownership of this property. I cannot stress enough how important that is to you. It is worth the money to make sure, and they'll give you insurance that there will be no future claim to the property that you are about to own outright. And a very good process that goes on. And in terms of private property ownership in a free market, that right there is extremely important. When we talked about Abraham, when he was burying Sarah, he wanted to buy that home, and he was doing it in a public area, where there were witnesses there. He was saying, this is how much I will pay for it. I will own it outright once I pay for it, and you Hittites will no longer have claim to this property. Okay, he was doing a title search. Okay, he was doing a title search, and everybody was witnessing it. That's basically what happened in that story of Abraham buying that burying ground for Sarah. Okay? He got the legitimate claim to the property. Private property ownership is absolutely crucial in a free market economy. Okay, we're going to take a few minutes to look at this settlement sheet. I'm not going to overload the donkey here. I just want you to look at it and be aware of it. This is probably the most important document that you need to be scouring for accuracy. And you need to know what it looks like so that you have the opportunity to come in and review it. And I'll tell you right now, on my last transaction that I made, my real estate transaction, I found a $3,000 error. This is no joke. I thought it was just another fee, but I asked about it because I didn't understand where it came from. My lawyer missed it, the title company missed it, and I almost paid it, and that would have been a disaster. So what I did was I took that money and that I saved myself for having done my homework, and I went out and I bought iPhones for my sons. That was great. I did, because that was money found, basically. I almost lost $3,000 in this transaction. But having done my homework, I went out and rewarded my two boys with a couple of new iPhones. And boy, that was a great day at the Apple store. You're looking at a settlement statement, and this is one of about a foot-high stack of papers that you're going to sign when you go into a closing. All right, so if you are the buyer, okay, you are purchasing a home, this left-hand column is where your numbers are going to be entered. It says the summary of the borrower's transaction. Now, you are the borrower, right? Because you are taking a loan, and so that's why your name is called the borrower. On the right-hand side, these are the fees that the seller is going to have to pay or the seller is going to receive from the transaction. So everything's going to come out in the wash, and at the end of the day, what kind of cash or is the title company going to collect from you you're going to have to bring a check or some kind of debit information, because you're going to have to pay some fees here, and they're going to ask you to bring that check to the closing. And the same thing from the seller. Now, the seller should be going home with a big check. That's how it should all work, but sometimes it actually doesn't work like that. But here you have these numbers, okay? The gross amount due from the borrower, less amount paid by the borrower. Remember that escrow check? Okay, that's going to be part of what goes there, and we'll go up there and look at that. And this is the cash that's going to be taken from the borrower to settle out this transaction. And over here, gross amount due to the seller. This is how much you're giving the seller, but it's going to be, what's going to be taken out are things that the seller is going to have to pay for, and we'll go over those up here as well. So let's go over those two things. Just a couple of things in here. Okay. On the left-hand side, the buyer, or here named the borrower, this is the contract sale price. If you agreed to buy this home for $125,000, that's what goes here. Settlement charges to the buyer, or the borrower. Now, the settlement charges, you've got to go to this next page. This is all the information. These are all those little things that somebody's got to decide who's going to pay for it and how much it's going to be. Let's just go over a few of these. The broker's commission. Okay, this is what goes to the real estate agent. Remember I told you that 6%? The buyer gets 3% gets a 3% commission, and the seller's broker gets a 3% commission. The loan origination fee. Remember, this is the loan officer's, basically his commission for doing a lot of the work to make this loan happen. The loan discount point, okay, that might go there. The appraisal fee. Remember, you're going to have an appraisal done, and the bank is going to have that done. The bank's probably going to decide who does that, and they're going to charge you an appraisal fee. I mean, these things can be up to $500, $1,000. They're going to run a credit report, probably $20 here, okay? Lender's inspection fee, okay, to have the home inspected, to make sure there's no major damage and to list what's wrong with it. Mortgage insurance application fee. Now, if you're not putting down that 20%, This is that mortgage insurance, but this is just the fee to apply for the insurance, okay? It's not the insurance you're going to pay, just a fee for the application. Tax service fee, they're going in, they're finding out how much you're going to owe in taxes, they're following up with all that property tax information. Somebody's going to go look and find out what that is. Flood certification, God help you if you're in a flood zone, okay? Because that's going to open up a new can of worms. If they find that you are in a flood zone, you are not going to be able to buy this house without buying flood insurance. And I'm going to tell you right now, there is one seller of flood insurance, and that's the United States government. Okay, they have somehow managed to take over that industry of insuring against floods. And they set the prices, and they are absolutely skyrocket prices. If you find that you're in a flood zone, you may just decide, forget it. I'm not buying this house. This would be a huge problem for the seller if they found out they were now in a flood zone. And what they do, they rewrite these maps all the time. And so they're redetermining stuff, and you don't even know it. You're not aware of when the government decides, oh, you're in a flood zone now, and you can't sell your property. Whoever buys it's got to buy flood insurance. Well, that's a huge, cold wet blanket on trying to sell your home now. Okay, that it devalues the home. Okay, here's where the property taxes come in. That you're selling this, say you're selling this halfway through the year. Well, you're going to have to continue to have property taxes paid on this thing, but the seller has paid property taxes on here, and he's already responsible for this first half a year of the property taxes. So you want someone going in and looking at the total property taxes you're going to have to pay, but you shouldn't have to pay an entire year's property tax. The owner owned this house for half of the year, so you should only be paying half the amount of a total year's property taxes if you're buying this house in July. Okay? Make sure this is accounted for. Don't get stuck with the whole year of property taxes. Title charges. Okay, these are the title company going in and ensuring that you're going to have a legitimate and sole claim to the title of this property, rather. But the bank, remember, the bank will have a loan on it, a lien on it, because they have basically purchased 80% of the property. So until you pay off that loan, they're going to have a lien on it. That's probably should be the only lien you see on your home. The title insurance, that's going to be significant. The lender's coverage, the owner's coverage amount. The lien certificate has to be generated. Judgment reports. Sometimes if they find problems and they're trying to investigate it, they've got to go secure those reports from a court somewhere. Okay, court copies, copy charges. All right, you're not going to get away without paying for all this stuff. This is the government recording fee. Okay, so there's a transfer that's going to be made on the title of this property, and the county wants their money for it. Okay, look, they're even going to charge you for the little stamp. Okay, the survey. You as the buyer should not be paying for this. Make sure that the seller pays for this, because they did the improvement and they changed the existing survey, and they're selling this property, so they need to provide you a survey, because this will not be cheap. I mean, we're talking, it could be anywhere from $1,000 to $2,000 to have this survey done. All right, and so there's other things. But anyway, this is the total settlement charges, okay? There's going to be a total here. It's going to be itemized in these lines right here. And, it's going to be determined, what do you owe of those things? Here's the earnest money. You put $2,000 down. They need to note that. Don't let that get out of hand. And down here again, this is the amount that the borrower is going to have to bring to the table at closing. And this amount over here in this box, these are the two most important boxes, okay? This amount over here is what the seller's going to go home with. So the seller is going to go home with hopefully a big positive amount there, because they did all this work. Hopefully they had a good transaction, and they're going to go home with some nice proceeds from this sale. Now, this link I'm going to give you to the settlement sheet has an explanation of all these line items. Okay, use this tool, okay? Because it's going to further explain all those little lines. Find a quiet place to sit down before you go to this closing table and sign these documents, and this will be one of the ones you're going to sign, and go over these numbers. And that's going to do it. So let's do this last section on the maintenance costs, just so you know that, the costs don't end once you close on this deal and the escrow period ends. You've still got things that you've got to think about now that you're living in a home. You need to make sure that you've got your home covered in insurance. Now, of course, this is going to be required of you if you're getting a loan. I mean, if you're paying cash outright, you probably got a lot more going on. But the mortgage company is going to mandate that you have coverage on this home, and they're probably going to mandate what you have to have for coverage because they don't want the house to burn down and nobody's there to pay for the loss there. Okay, so you've got to have it covered by insurance. That's expensive, though. That insurance cost is going up and up and up. PMI is private mortgage insurance. Remember, we talked about loan to value, the LTV. If you don't have 20% of the value of this home invested already, you're basically paying for your inability to put at least 20% of value into this house. In other words, you're saying, I don't want to put a lot of skin in this game, but you're going to pay for that. It is totally unnecessary for you to have to do this. If you can't put 20% down on a property, don't buy it. Be ready, be able, and be prepared to put 20% down onto your home. Don't sell too soon. Real estate transactions, minimum 10 years. Try to hold on to it for 10 years. That's when you're really going to see a difference in the price of this home, the market value of this home. Okay, property taxes. You're going to owe property taxes on this home every year. And what's going to happen is typically if you're taking out a loan, the bank is going to, this is different from the escrow period, but they're going to charge you as part of your monthly payment the monthly amount of what the estimated property taxes are on this home, and they're going to keep it in an escrow account. They're basically going to put it into account. So at the end of the year, when it's due in January, like in Texas, it's due January 31st for the previous year's property taxes, they're going to pay off your property taxes, okay? But I never opted for that. I kept my own money in an account for the whole year, got interest on it, and then in January just paid that bill. But it's a big bill, and it's a big shock if you're not prepared for it. Well, I think that covers it in terms of buying a home. Real estate is a great investment, but it is laden with traps, and you do not want to fall into one of these traps. Okay, take a break, because I know your brain is probably just jello at this point. Take a break. We'll come back, and we'll talk about another big topic, taxes, okay? What we're doing is we're talking about you at your full-blown economic activity period of your life. You are handling big purchases, you're making big money, and now you're going to be paying big taxes. We are on Unit 2, and this is Lesson 3 of Economics, and we're going to have a third part of this lecture where we're going to talk about paying federal income tax. All right, so There's a lot of taxes you pay all day, but typically these things are rolled into the price of what you're paying. So you don't have this event where you have to specifically sit down and pay your sales tax. When you get a job even in high school, if you're working, let's say you're working at the Sonic for the summer, or you're working there after school, you're going to have to pay income tax. You're going to have to file a return. You have to specifically sit down and perform an action that shows that you have acknowledged the income you've made, and you are filing a return that says either I owe some money or I'm going to receive a refund back. But this is a specific action that you must take every year. The IRS, the Internal Revenue Service, that federal agency, is extremely powerful, and they don't take no or I forgot as an answer. When you're in high school and you've got that job at Sonic, or maybe you've gone on to college and you've taken some kind of waiting tables job, it doesn't matter what it is. If you are getting income from anybody, you've got to file a federal return. And we're going to talk about that today. There's lots of ways to go in and take care of this very easily. Typically, for someone, who's young and has just a very, you don't have any dependents, you don't have anything to deduct, you're going to file a 1040EZ. I had on here the TurboTax link. If you go to that link, and I'll put it on the website, it'll give you an estimation. You just kind of put in a few numbers, answer a few questions, and it's going to give you an idea of what you can expect for a return or what you're going to have to pay. Now, whether you claim yourself as a dependent or your parents claim you is a very important decision to be made. You've got to decide, are my parents going to continue to claim me as a dependent? Because, see, that's a tax break for them. Because obviously they are still investing in you. Even though you may be at college, they're still paying for you, maybe where you're staying, they're paying for your college. And they can do that until your age of 19. And if you're in college, they can continue to claim you until the age of 24. If they do that and you're going to file a 1040EZ, you're not going to get that dependent exemption. You're not going to be able to claim yourself. And so what happens is you make an income, and they're going to, it's automatic that you get to deduct some of the amount that you earned from your taxable income, because you have living expenses and you're paying for them. So what they do is they come up with an amount and say it's, $6,000 a year. Well, if you're only making $10,000 a year, that means you're only going to pay taxes on $4,000. Okay, that's a pretty significant cut, especially for someone your age and with your income. That could mean that's the difference between having to owe taxes and having no taxes to owe. So that's one of the biggest things you need to determine. If your parents are going to continue to claim you, then, make sure that it's because they are helping you. They are giving you money to pay for your living expenses, to pay for college, etc. They're actually doing that. They're offsetting some of your expenses. But if they're not, if you're completely independent, then you want to be taking that exemption. The other thing that is important, especially for your income level, is this earned income tax credit. And I'm just going to say straight out right now, this is the redistribution of wealth. What you're seeing here is information on the IRS website that talks about earned income credit, okay? And this is for this previous year. Now, what happens here is that they giving you a credit, it's like literally they're giving you money back, okay? What it sounds like is that, okay, you had a certain income level, you owed taxes on that income, but you're getting a credit against the taxes that you owe. But the problem is what they've done over the years and of these past few decades is that they give you more money back than you would have owed in taxes. So you're getting money that you didn't even earn back. And this is how it works. So if you see right here at the top of this screen, it says, what's circled here is your income amount, okay, your taxable income amount. And then over here, they're telling you, okay, how are you filing? Well, if you are indeed single and on your own, you are considered head of household. In other words, you're responsible for everything, all of your living expenses. You're living on your own. You're filing head of household. And these numbers right here are indicating the number of children you have. So either you have no children or you can have as many as 3 children. And each child you have is an additional tax credit. Okay? So, but even if you have no children, you could claim no children and you'd still get this tax credit of $189. So, but if you look at the numbers there, if I truly only had a taxable income of $2,450, and probably there is, probably the tax obligation for that is only going to be 10%. So if I took 2,500 and I multiplied that times, let's say it's 15%. It's 375. You're going to get a tax credit of 189. Now, if you had a child, you're going to get a tax credit of $842. Okay, that's not the amount that you would owe as a dependent. As a single head of household with one dependent, you would not owe that money. You still would not owe that money. So you're getting a credit back on money that you didn't even owe. You're just getting a check from the IRS that is paid by the taxpayers. And the case is true for this. So if you had 3 children and you only made this much money, you're going to get a check in the mail for $1,114 minus any taxes that you might owe. Okay, but remember, when we looked at this situation, you didn't owe anything. Okay, you may owe if at most you owed like a few $100s. So basically, you're going to get $800 and an earned income tax credit check. This is something people look forward to every year because they're getting this massive check in the mail, most likely, because once you get up into tens of thousands of dollars in income, this amount goes up significantly. I mean, it could go up to $4,000, $5,000, $6,000 as a return. And if you look around January, February, March, they come in, they get an accountant set up in their car dealership, and they say, "Come on in, we'll file your tax return, and you can use your return as a down payment, or you can buy a car with it." Okay, they have learned that game because they know there is a massive tsunami of income, cash coming back to the populace that is getting these earned income credit checks in the mail in the early part of the year from the IRS. About 40% of the population actually pays taxes on their income. And we're at this critical tipping point where that's just, in other words, you get to this point where this redistribution of wealth is not going to be able to be sustained by the taxpayers who are actually paying taxes anymore. Okay, that tipping point is coming. It's not quite there yet, but it's coming. Okay, just a couple more things here before we go on, actually look at the 1040EZ, and then we're going to be done with this part of the lecture. All these taxes and what you have to pay, they put them in a tax table, and that's what you may never even see that tax table, but if you were to actually file things on your own and be looking at these tax tables, what you're doing is you're opening up one that you just saw, like with that earned income credit, and it's showing that you are indeed, looking at the specific amount of income that you have, and it's calculated, and it shows you there how much you're going to pay for that amount of income, amount of taxable income. A lot of time what happens with these tax filing softwares is that you almost never see that table because they're just going to determine it for you. They're going to go through, and their software is already calculating all these things as you fill out your taxes in that software. So just so you know, that's the way it used to be done. I mean, we used to fill it out by hand, go to the tax table booklet that you got, and you were able to see, okay, so if I just find out this is my taxable income, and over here on the side, this is what I owe, just like we saw on the EIC earned income credit table. Okay, the other thing is, if you're venturing out on your own and you've got your own business, it is extremely important that you have good accounting records. You need to keep receipts of things that you buy, business expenses that you have, especially things like mileage that you're using on your car, anything you buy for the office, whether it's a printer, especially when it's things that are infrastructure like items, big items, whether it's, you're paying rent, even if you're working out of your own home, you can deduct the rent or your mortgage. You can deduct the mortgage interest. Okay, it gets really complicated, and you're going to need help at some point. But there's lots of things. Your computer, any expenses that you're buying, like paper for the printer, software for the computer, all of those things. If you go to a conference, all of those expenses, those travel expenses are deductible. Your goal is to get down your taxable income as low as you possibly can. Because remember that on the tax table, that number is going to determine how much tax you're going to pay. So, there is a lot of incentive here to keep good accounting records so that you can make sure that you're not forgetting and you have some kind of credibility. You've got to have backup for these expenses that you're going to deduct. But you put all those deductions in, and you're remembering to do that because you have some kind of receipt that shows you, okay, I spent this much on technology this year. I spent this much on mileage this year, and then that gets added up into one big total for mileage or business travel. And then that gets deducted off of your amount on the tax form, on the return. Okay? This is important not only so that you can keep your business taxes as low as possible, but you need to do this because if you get audited, and the IRS does audit people, I mean, sometimes it's random, sometimes it's because something you've done is being flagged. They're going to come in, they're going to expect to see these receipts, and they can demand them, and you must submit them if you want to perform well in this audit. Okay, there's probably no worse fear in a business person or an individual's mind than when the IRS knocks on the door and wants to see your business receipts. Okay, that is not going to be a pleasant experience. Okay, keep good records, do it legitimately. Okay, you must be able to substantiate any deductions that you take. All right, if you get in and make this stuff up, it's going to come back to bite you. You've got to be able to substantiate it. There's lots of softwares now that do this online. You can take a picture of a receipt, or you can just enter an amount somewhere, or it'll keep tabs of your travel online on a piece of, on some kind of software, your mileage. So take advantage of those things, because what happens is all those little apps and stuff can roll right into a tax preparation software, and then it gets put in there and totaled for you. You're not sitting there with a whole literally, we used to have shoe boxes full of receipts, and you're just rifling through all that stuff, trying to put it all together and tabulate it and separate it and total it and put down that number. Okay? So take advantage of those things. Okay, we're going to venture into the tax filing jungle. All we're doing today is filling out a 1040-EZ. This is the simplest tax form that you can fill out. And you're going to find out that it wasn't so simple. Okay, that shouldn't have been checked there. All right, so let's just get started here. Most likely you can do this online, or you may be having someone do it with you, but I'm going to do it for you. But I'm just going to go through and do it line by line so that you can see what is actually happening. Obviously, all these things, you're going to fill out all these things. I'm going to assume that you are not married, that you are indeed single, and you do not have any children, and you have no dependents. Okay, this would be the simplest way to do this. You're going to put your name, you obviously don't have a spouse. You're going to put your home address, and over here, make sure you've got your social security number right. Okay, you don't want to be doing that wrong. Presidential election campaign. Check here if you or your spouse want $3 to go to this fund. Check a box. It will not change your tax refund. Okay, basically this is just that from the revenue they get, $3 will go to the presidential election campaign fund. Actually, I don't even know why they would even need that $3. They raise so much money as it is. Okay, but either way, that's what all that is. You're not gonna get deducted $3 from your return or get $3 added to your tax. They're just using the revenues they collect to put into the presidential election campaign fund. Okay. You're going to start here with line number 1. Now, what happened there? Okay. You're going to start here with line number 1 under income. You want to put in your wages, salaries, and tips for the entire year. Now, you should have had a W-2 filled out. What you're going to do here is you're going to receive in the mail a W-2, and that's going to be filled out, not blank like this one. Your employer filled this out, and they're going to put the total value of income that you received from them over the entire year. So you're going to find in this space a total of all your paychecks for that tax year. And the tax year is from January to December, obviously. You should receive this no later than January 31st. So really the only thing on here, you can look at these other values, but for the purposes of filling out this 1040-EZ, you want this number in the box number 1. Okay, so I'm going to say that number is $10,000. We're just going to make it a nice round amount. Okay? And on line 2, so this is your total income, okay? Nothing taken out of there, okay? That is the total amount of money, income you earned. Now, if they were taking out taxes, you didn't get that whole $10,000, okay? We're going to deal with that in just a minute. But they paid you, that you earned $10,000. Okay, now over here on line number 2 is taxable interest. Okay, so if you have a bank account, you have a savings account, and you have, $2,000 in that savings account, well, interest rates are really pathetic. So most likely you're not going to have a whole lot here, but what you're going to get is you're going to get a 1099 interest form in the mail the same time, you're going to get it before the end of January, just like your W-2. And that looks like this. And of course, it's going to be filled out because the bank will have filled out this information on here. And this 1099-INT for interest is going to show in this box number 1 the amount of interest you earned, like in a checking account or in a savings account, or maybe you bought a CD, which I encourage you to do. It's a little more interest, not that much. The value that's in here is what you're going to put on this line number 2 here. Okay, and you may have multiple accounts, so you're going to have to add those up. But I'm going to say you just have one account, and since interest rates are pathetic, you only made $35, but you have to report it. Okay, it's important that you find that, get that number, and report it. Okay, unemployment compensation. I'm putting 0 here because I'm saying you did not file unemployment for unemployment compensation. So I'm going to put 0 there. But if you had, let's say you lost your job and you filed for unemployment, they're going to take that amount and you will be taxed on the amount you received there. Okay, line number 4. Add lines 1, 2, and 3. This is your adjusted gross income. And obviously, the adjusted gross income for you is $10,035. Okay? Now, line number 5. This is what we were talking about just previously, about your parents claiming you on their tax form. If someone can claim you on your spouse, but we're filing single, so that does not apply. As a dependent, check the applicable box below and enter the amount from the worksheet on the back. So I'm going to check that we're not dealing with spouse. If I had not have checked this, you could have subtracted $10,400 from your income. Okay? From this number right here, which obviously would make it a negative number, and you wouldn't owe anything. So that would have been your credit that you could have, like your exemption amount. Okay, so let's look at the, do I have the form? No, it's going to be, the form was down here. Yes, down here. Okay, so this is what we're going to do. On this form right here, you're going to determine how much you can deduct, okay? So you're going to take the amount from line 1, which was $10,000. And you're adding $350 to it, okay? And you're going to enter that here. So you've got $10,350. And they're saying the minimum standard deduction is $1,050. Line C says this is just a worksheet for how we're going to enter line 5 up here, okay? So you can find out how much you can deduct out of this. You want to pay the least amount of tax as possible. So enter the larger of line A or B, and obviously that is going to be the $10,350. The maximum standard deduction, if you're single, is $6,350. You're not married, so we're not going to enter that. You're just entering numbers here, and they're going to compare them. Okay, so you entered the $6,350 because they're just asking you enter one of these two. Now, they're asking you enter the smaller of line C or D. And the smaller is obviously $6,350. So we're going to put that there. This is your standard deduction. They're saying because your parents have claimed you, you will be able to take a deduction, but it's going to be less, and your standard deduction for the purposes of this 1040EZ is $6,350, and that's what you're going to enter on. Okay, hold on. There's a little bit more here. The exemption thing is whether you're claiming, like if you had children, you would claim more. If you were married, you would claim more. But on the exemption amount, you're single, so this is 0. Okay, if you're married, you would be, you might claim your spouse, and that would be $450. That's if they're not claimed on another return. Do you see why I'm calling this the jungle? Okay, I mean, it's just the fact that to get one number, I've got to fill out all of these things is ridiculous. Okay, so you're going to add E and F together. You're going to add your standard deduction and your exemption, which could have been $4,050. Okay, but obviously you didn't have one because your parents are claiming you. And you're going to add those together, and of course, that is going to be $6,350. This is the number that you put on line 5 at the top here on the 1040EZ, okay? We just did the worksheet to determine what your deduction was going to be here, what this value was going to be here. So it's $6,350. Okay. All right, now subtract line 5 from line 4. This is line 5, and you're going to subtract it from your adjusted gross income. Okay, I'm going to do that. I already did that calculation, and I've got a number here, $3,685. Okay, now this is your taxable income. And you want this number as low as you can get it. That's why doing this deduction was very important. See, you were going to be taxed, on $10,000, but you were able to take a deduction of $6,350, even though your parents claimed an exemption from you for you. You still get a standard deduction of $6,300 from this amount. And that's what brought your taxable income. In other words, we're going to go to a tax table and we're going to find out how much you're going to pay on this amount right here. Okay? That's the beauty of the deduction. Now, if your parents had not claimed you, you would have been able to enter this $10,400 and you wouldn't have owed anything because you didn't make enough, and your deduction completely zeroed out your taxable income. Okay? Nevertheless, this is a situation we are dealing with here in this particular setup. Now, on the next part, you're going to be determining how much you've already paid or what kind of earned income credit you're going to get. Okay, so federal income tax withheld, that's going to be on the W-2. Okay, in line number 2, in this box number 2, they're going to put here that they took out taxes every time they gave you a paycheck, and you need to be able to know how much it was that they took out of your paycheck. I'm just, for the purposes of this form, I'm going to put out that they took out $1,500. Okay, in taxes over the year. That's roughly, it's 15%. Okay, of your income. All right, now, just stay with me here. We're just determining how much you've already paid into the system. Okay, earned income credit. The reason why I say, and the reason why they put it here as what you've paid into the system, is that they consider it something you've paid into the system. So we're going to go over to the earned income credit table, and we're going to find out what you, quote, earned in a credit from the IRS. Okay? I don't even know how to say that to make it make sense, because it doesn't make sense. I mean, look at the name and look at what we're doing. We're just basically pulling money out of thin air. All right, so go to this form. Remember, we did this. We went to this form, and we looked at this earlier. Now, I'm going to go over... No, you need to find your amount. Okay. You're going to go to that form, and you're going to look at your adjusted gross income. No, you're not. You're going to look at your taxable income over here, $3,685, and this is how you're going to determine your earned income credit amount. So we're looking for $3,685. Okay, we're at 3,650 to 3,700. Okay, that's where we need to be. And remember, the first entry up here was a single person that's head of household that has 0 children, 0 dependents, okay? You're going to get an earned income credit of $281, and we determined that from this table. Right, so your earned income credit is $281. Okay, non-taxable combat pay, that's not going to apply in this situation. Add 7 and 8, and this is the total payments and credits that you have. And that number is, when added together, is $1,781. Okay? This is what you've, quote, paid in already to the IRS. Now, what you're going to determine here on line 10 is the amount of tax that you owe. Remember, this is not sequential. We are determining different things on these different lines. Some of them relate to each other, some of them don't, okay? But what we're determining here is just what would you owe from this amount on the tax table, from this $3,685. So I'm going to go to a tax table right here, enter the tax from the table on this line. I'm going to the tax table. All right, this is the tax table from 2017. And they've made it a lot easier than they did 40 years ago when I did this. Well, maybe not 40. Okay, so I'm going to where it says 3,000. That helps me kind of get my bearings in terms of income. And I'm going to go down the same way I did it on the earned income credit. And I'm going to find the number. I'm going to find where 3,685 falls. And of course, this is 3,650 to 3,700. So my tax for a single person is $368. Do you see that right there? So I'm going to go back over here and I'm going to enter that right here. 368. Okay? That's how much tax I owe. Now we're going to do the let's go to the next line. Health care. You're responsible to be covered on health care. Okay, that's what Obamacare, the individual mandate is. Okay, you must be covered on insurance. It is federal law now that you must be covered. And most likely your parents are covering you, because I can't even imagine how you could afford your own health care, especially on this income, to purchase it yourself. But maybe you did, but for the purposes of this form, we're going to say your parents had the full year's coverage of you under their health care insurance. Okay, so, and of course, if you didn't have it, there would be a penalty here. Okay, so I'm just going to put 0 because you were covered and there's no penalty. All right, they're telling you to add lines 10 and 11, and this is your total tax. Okay, because see, if you'd had a penalty here, that would have been a tax. Okay, they would have taxed you because you didn't have health insurance. But that case is not true for this purposes. Okay, so your total tax is $368. Okay? All right, here's where we determine whether you get a check or whether you write a check. Okay? All right, 13A. If line 9, the 1781, that's all your credits, is larger than line 12, okay, the 368, and it is, subtract line 12 from line 9, you are getting a refund, okay? So when I do the calculation, I see 1,413. Whoops, not 14,000. Okay? You're going to get a check in the mail or in this bank account that you could put in here, routing number, etc., of $1,413. Why? Because the whole time, all year, you were paying, the your employer was paying your taxes for you. They were sending in this money to the IRS, and they had deducted it from your paycheck, and you in the amount of $1,500 over the entire year. And also, look here, you got an earned income credit of $281. So that pretty much offset your taxes, except for what, $70, $80 there. All right, you almost got your entire amount of tax that you owed basically credited by this earned income credit. Now, if you'd had a child, you'd have had more than this, okay? Or if you had multiple children, this is where the numbers get into the thousands. And this is how people are getting refunds in the thousands just on their earned income credit alone. Okay, but in this case, you actually did pay $1,500 and on this $10,000 that you earned, but you didn't end up owing that much. Your taxable income was only this amount, and it was determined that you only owed $368. That was subtracted from your credits, and now, since you had a credit, you're going to get this as a refund check from the IRS. Okay? Now, if they hadn't taken any money out, and you didn't get it, and maybe you had done this and you got this earned income credit, but you had zero taxes taken out of your check, you would have owed a little money here, right? You would have taken that 281 from the 368, and you would have owed, what is that? $50, okay, 50 something bucks right there. All right, don't worry about that part. You make sure you sign it, you date it. Your occupation, your phone number. I don't know why they need that information. Okay, and then you're done. You've filled it out. Now, most likely someone else is going to do this, or you're going to do it online. But if you had to, you could send this in with handwritten if you needed to. Okay. The most important thing is that you actually do this work. You file this return. If you don't, the IRS will find you eventually. They will realize that you have been working, and you have not filled out this, jungle sheet, that we just went through, and they're going to find you, and they're going to let you know about it and you will be audited. You will sit down with an IRS agent, and they will go through, and if you're not complying with them, they'll freeze your bank account. I'm not playing around here. They're going to tell you when you go to the bank, your account's going to be frozen, any money you have in there, and the IRS will keep that freeze on there until they settle this issue with you. And that can take months or years. You do not want to be in that situation, okay? That's why it is extremely important that you take care of this situation, you take care of this form, and turn it in to the IRS every year before April 15th. Okay? Welcome to American Taxes. Okay, we're done. We're done with this lecture, with this lesson. That's quite a bit of stuff, but realize that what I was trying to demonstrate in this entire lecture is that once you get to that age and that situation where you're at your peak earning potential and you're at your peak buying potential at the same time, okay, there is going to be a lot of stuff going on. There's going to be a lot of these things you're going to have to start dealing with. And so that's why I wanted to go through all those things. You're buying a house, you have children, you're filing taxes, you're obligated to taxes. This is a lot of burden on a family, okay? And you want to be able to anticipate these challenges when they come to you, okay? So this is the things you're kind of looking at. In the next lecture, we're going to start talking about retirement plans. Well, we did talk about those already, but we're going to be actually talking about being in retirement. What are the issues that come with that? How do they impact your economic condition? And also wills and trusts, okay? When you pass away, you don't want your entire life's work and income to be squandered, to be taken care of. What will happen if you don't do a will? The government's going to come in and be the person that determines where your money goes. You don't want that to happen, okay? You want to take care of that legally. We're also going to be, dealing with other issues that come at end of life, okay? End of your economic life, okay? All right. Thanks for hanging in there. Definitely get a good meal today to make up for all the work you've done on this lesson. Take that quiz, and I will see you next time in economics class at GW Bridge Academy.